Guys see my screen yet or no?
Yeah.
Good.
Good, perfect. Oh, Dan, go ahead. Sorry, I was juggling things here, but I'm ready now. What's your question before we start?
I guess it's okay. I was just plugging in the numbers from S&P Capital IQ, and then my synthetic rating doesn't match the one that it generated. I don't know if that's normal or if I did something wrong. It's okay.
We'll talk about it after class.
All right.
Okay, so welcome, and I think the recording is on. Let me make sure. Yep, it's recording. Are there any questions before we start? Reminder that your quiz is on Wednesday, your third quiz. And as I said in my email yesterday, I have this option of taking, because I know for some of you, the multiple choice has been a kind of, has been something that's an impediment because it's all or nothing. And so I have an option of taking the quiz as open questions, which means you'll enter the scores, you send it in, and I'll grade it like a regular quiz. And remember, it's a trade-off. There are things you lose when it's not multiple choice. You won't have the answer obviously there. So if you get the answer, you can't check, but it's your choice. But make sure you sign into that Google shared spreadsheet by midday tomorrow, because I need to know in advance so that I can create a separate grouping for you so you can get the open quiz. Any questions about that before we start? Lauren?
Yeah, thank you for giving us that option. I just had a question, like in terms of like how we can show our work. Like I tend to like to work in Excel just because like
it'll be the quiz will actually be in an Excel structure. So each problem will be a separate worksheet. You'll go in and show your answer in that worksheet.
Okay. Okay. Thank you.
You're welcome. Any other questions? Okay. So today, here's what we're going to do. We're going to start on the third and final piece of corporate finance, which is we're going to talk about dividends. And I'm going to talk about this. In my view, dividends are perhaps the most dysfunctional aspect of corporate finance. Okay? Because if you think about where it fits in the big picture, here's where we are. The objective is to maximize the value of the firm. We've talked about the investment decision, how we want to take investments that earn more than your hurdle rate. We've talked about the financing decision, how the mix of debt and equity should be the one that maximizes your value, and how the right kind of debt for your company reflects where where you plan to invest the money. Today, I want to talk about the dividend decision. Let me lay out the first principles again. If you cannot find investments that make your hurdle rate, then the key is to give the money back to the owners of the business. But you're saying, but my company might not survive, so what? The end game for a business is not survival and sustainability. That's absurd. If the reason for your existence is gone, a corporation is just a legal structure, fold it and move on. There are other businesses you can go into. So the two questions I want to talk about in the context of dividend policy is first, deciding how much to pay in dividends, how much should you return? And second, once you've made the decision, I'm going to talk about increasingly the two ways companies explore of returning cash. One is to pay conventional dividends, and the other is to buy back stock. I think much has been made about stock buybacks that is not true, but I want to talk about both types and why some companies might pick one more than the other. So let's start about looking at the dividend decision in a sensible firm. In traditional corporate finance, if you're a sensible firm, dividend should be the end of a decision process, not the start. Let me explain. You have a company, it's got cash flows coming in from operations, from past projects taken. The first thing you got to decide is how much of that cash flow has to go to borrow. So if you borrow money, some of that cash flow is going to go to lenders as interest and principal payments, and whatever's left over is going to be cash flows from operations to equity investors. So that's the first step. Once you look at that cash flow, you have to decide how much of that cash flow you're going to put back into projects, into capital budgeting, into reinvestment. And whatever's left over is available to be returned to shareholders. I'm going to coin a version of cash flow that we've talked about before, but I'm going to be much more explicit, called free cash flow to equity. Sounds fancy, but it's potential dividend. It's what's affordable or what the company can afford to return to shareholders in the form of dividends and buybacks. But then the company makes another stop. It says, look, I'm not going to return all of that cash. I'm going to hold back some of that cash. You're saying that doesn't make sense. Why would you want to do that? Well, it might be because you need a precautionary motive, something in case something goes wrong, or to cover a future project. And some companies might choose not to return any cash at all, in which case it builds up in the company as a cash balance. And the final choice is, given that you've decided to return cash, dividends or buybacks. Shreya?
Professor, when you define free cash flows as potential dividends, where do dividends paid to preference shareholders feature in that?
Think of it just like interest payments. Preferred shareholders are not shareholders. They're just basically expensive debt holders. So think of that as another cash flow. So this is what common stockholders have available to be paid
Got
out
it.
as dividends.
Thank you.
So in a sensible firm, dividend should be the end of the process, not the beginning of the process. But as I said, dividend policy is extraordinarily dysfunctional. When you look at what companies pay in dividends and you try to make sense of it, more than any other aspect of corporate finance, you're going to run into a brick wall. You're going to say, why did they do that? Why did they? And it can take both forms. Why does my company pay so much in dividends? Or why does my company not pay dividends at all? So let's go to the two root reasons why dividends become dysfunctional. And I've talked about these as well in the context of other aspects of corporate finance, but in dividends, they rule. The first is inertia. A lot of companies pay as dividends what they've always paid. So if you ask me, why are they paying what they're paying? Just look at the history. Or why they're not paying dividends, again, look at the history. So inertia. The second is Me-tooism. Why do banks pay a lot of dividends? Because banks are supposed to pay dividends, and every other bank pays dividends. You feel the need to pay dividends. Why do tech companies not pay dividends? Because tech companies don't pay dividends, and because they don't pay dividends, you choose not to pay dividends as well. Notice how inertia and Me-tooism explains so much of corporate finance. We try to come up with intellectual rationales for things, but there's really no good reason other than this is the way we've always done it. Why are you upsetting the apple cart? So I'm going to start off by listing out some facts about dividends. And I'm going to talk first about US companies where I have the longest history, but I'll talk about how it might be different in other parts of the world as well. So let's start with traditional dividends. You know what I mean by traditional dividends, right? You buy shares, every quarter you get a dividend. The word I would use to describe dividends is they're sticky. You know what I mean by sticky? In most years, companies pay as dividends what they paid last year. In fact, to back this up, let me show you a graph that I update every year. This graph, here's what I do. I look at the number of companies that increase dividends every year. That's a green column. The number of companies that cut dividends every year, that's a red column. If you compare those two already, what do you notice? That there are probably 4 to 5 times as many companies that increase dividends than cut them. Dividend increases are far more common than dividend cuts. But don't get too excited. Those two groups are outnumbered vastly by the companies that pay what they did last year. Most companies in most years pay as dividends what they did last year. In fact, take a look at your own company. Look at its dividends over time. If it's paid dividends, you're going to be amazed at how stable and sticky that number is. You think, but what if there's a crisis? In fact, during a crisis, you realize how sticky dividends are by just looking at the numbers. Take 2020. It's a horrifically bad year for many companies in terms of operation. Their market price might have done well, but you look at hotels, you look at airlines, you look at cruise line companies, you look at many manufacturing companies. 2020 was a terrible year. During 2020, 287 companies out of the S&P 500. This is a bad year. 287 companies managed to increase dividends. And 11 started paying dividends for the very first time in 2020. It is true that in 2020, 27 companies cut dividends and 42 companies suspended dividends. Those are high numbers. But the fact that even in 2020, 69 companies, that's the sum total of all the companies that cut or suspended dividends out of 500, tells you a great deal about how sticky dividends are. In fact, I have a similar table for 2009, another terrible year in terms of the economy. But even in that year, the number of companies that increased dividends vastly outnumbered the companies that cut or suspended dividends. Dividends are sticky. Here's a second way in which I would describe how dividends are set. Dividends tend to follow earnings. Ashwin, you have a question?
Yeah, Professor, and maybe this will come up later, but couldn't the companies just say, oh yeah, because it was a bad year, we didn't have any investment opportunities and we just wanted to give the cash back to the shareholders? Would that be a possible rationale there?
It could be, right? But then, you look at a hotel company, they're not planning to build more, so in a sense, for companies which have no investments, maybe this is the year that they came to that. But I think still you'd expect a lot more companies to cut dividends in a bad year if dividends were truly responsive to your finances. I mean, many of these companies that increased dividends actually lost money during the year, but they continue to increase dividends. So there's a strange disconnect between what you see in operations and what these companies are doing. It's almost like there's a dividend guy at the company who doesn't even look at the company. He says, this year we increased dividends by 5%. You ask him, why do you do that? Because that's what we do every year. I mean, that might be a cynical way of thinking about it, but that's what I see when I look at companies continuing to increase dividends. Maintaining, I can understand, but why would you want to increase dividends? That sounds like you're asking for trouble. The second way I would describe dividends is they tend to follow earnings. Key word is follow. They don't lead earnings. They're not contemporaneous to earnings. And this might go to Ashwin's point, because here's what you will tend to see. If a company has a good earnings year, dividends usually don't go up that year. If it has 2 good earnings year, maybe dividends will go up next year. If you have 3 good, maybe you'll see a dividend increase. It takes a long time for companies to adjust. So maybe the 2020 cut in dividends will show up in 2021 and 2022, because historically dividends are a lagging indicator. They don't lead earnings. They're not contemporaneous. They come behind earnings. And dividends, and this should not need to be said, but I'm going to say it anyway, are affected by tax laws. And here's why. If you're a shareholder in a company, when you get paid dividends, historically, you've been taxed on those dividends the minute you get them. Let me explain what I mean by that. What's the other way you make money on stocks? Morgan, you get dividends. What's the other way you make money on stocks? Stock price goes up, right?
Yeah.
But when do you have to pay taxes? The stock price goes up. Only when you sell. Go ahead. Depends on what?
When you sell, whether you have to
When
pay
you sell the
short-term
stock,
or
right?
long-term. Yeah.
And in fact, if you don't sell, there's no tax. But if you do sell, there's a capital gains tax. And anytime the government changes those relative tax rates, it can affect dividend policy. I'll give you an example. In 2012, let me go back even further in time. In 2003, there was a Tax Reform Act. And the Tax Reform Act brought down the tax rate on dividends to the same rate as capital gains, 15%. So with dividends and capital gains, for the first time in US corporate history, were being taxed at the same rate, 15%. But the way this tax law got passed is it used budget reconciliation. For those of you who've been tracking what happens in Congress, you need to get, this is one of the few things that can get by without a filibuster in the Senate with 51 votes. But the nature of budget reconciliation is you need to make it budget neutral within 10 years or after 10 years. So what this law had, and this is a terrible way to pass tax law, was a sunset clause, which is everything in the law would expire on December 31st of 2012. The whole law would disappear. Strange way to write corporate laws, right? And the assumption was, hey, we have 10 years to fix this. I'm sure we'll come back to this and make sure it's permanent. Well, Congress being Congress, guess what happened? 2004 rolled around, 2005. You get to the middle of 2012, and they still hadn't got around to deciding what to do. So can you imagine being a company or a shareholder in the middle of 2012? For 9.5 years, dividends have been taxed at 15%. If nothing changes in 6 months, what's going to happen? Dividends are going to get taxed at the ordinary tax rate, 40% or 42%. So in the last quarter of 2012, you saw this burst of companies paying huge amounts in dividends. You see why? Because they wanted to get the dividends in before the tax law changed. Eventually, Congress compromised. I think they actually passed the law on December 29th of 2012, 2 days before it was supposed to expire. Talk about cutting it to the really close. They renewed it, but the fear that it would not be renewed led to a burst of trading towards the end of the year. Now, some of you know that one of the things that's being talked about is an increase in the capital gains tax rate, not for 2021, but perhaps for 2022, for people who make more than $1 million to 43.4%. Now, I'm not going to debate, good, bad. There are all kinds of issues that can affect value. But this much you can predict: if that law passes, there's going to be a burst of trading towards the end of 2021 of people trying to get the old capital gains tax rate, which is 18% or 20%, rather than wait until January 1st and get taxed at 43.4%. This happens around every tax reform that the Congress plans to pass, because tax laws can affect how you look at dividends versus capital gains. And finally, and this I think is the feature of dividends that has changed the most in the last 40 years. When I did my MBA in 1981, 95% of companies paid out, return cash only in the form of dividends. Buybacks were very uncommon. It's not that they weren't done, they were very uncommon. Sometime in the mid-1980s, companies started to return cash in the form of buybacks. And in this graph, you can see the percentage of cash returned in the form of buybacks. That's a black line. And as you can see over time, that percentage of cash returned by shareholders in the form of buybacks has gone up almost every year. By 2019 or 2020, more than 60% of the cash returned by companies took the form of buybacks. Even 2020, when they had a cut in buybacks, you could see that the bulk of the cash returned by US companies took the form of buybacks. This is not a short-term phenomenon. This has been going on for quite a while. And in case you're thinking this is just a US phenomenon, think again. This is starting to happen around the world. It's not just in the US, but elsewhere. And the way to see this is to look at the second to last column on this table. See the percentage of cash returned from buybacks. African companies return only about 6% of the cash in the form of buybacks, but Canadian companies return almost 31%. So the US is still the place where you see the largest percentage of cash returned in the form of buybacks. But this is a phenomenon that's starting to catch on around the world. Now, you'll read a lot of stuff about buybacks. Most of it is, I think, either partially informed or misinformed. But let's ask a question. This is not something that's happened just in the last couple of years. Over the last 4 decades, companies seem to have shifted away from paying dividends to returning cash in the form of buybacks. What do you think is driving the shift from dividends to buybacks? And as you think about it, you got to think about factors that have changed over the last 4 decades that are pushing companies. Because if you name something that's always been there, I'm going to say, well, what happened in the middle of 1980, the middle of the 1980s for this to kick in? Kushal, what do you think explains the shift from dividends to buybacks at US companies and increasingly at global companies?
I think we're seeing, I look at tech taking up more of the market now than it did previously, and they're more inclined to not make a sticky payout in the form of dividends.
So
as opposed
that's
to
a
buybacks.
good point. So connect the two. What is it about tech and sticky so tech companies obviously make a lot of cash flows. You look at the Apples, the Googles. So clearly they have the capacity to pay dividends, but why are they less willing to adopt a dividend policy for the long term than the great companies of 50 or 100 years ago? What is it about tech earnings that makes them more reluctant?
Just more volatile.
It's more volatile. In other words, remember the word I used to describe dividends? They're sticky. Once you start paying dividends, you're stuck paying them for the rest of eternity. I mean, the great companies of the 20th century felt more. I mean, I'll give you a very simple example of how the world has shifted. 40 years ago, if you'd asked me to list out 100 companies with stable and predictable earnings, I'd have had no trouble coming up with a list of 100 companies. Consumer product companies, companies that are domestic markets nailed out. Today, I'd have a tough time getting past 10. Fewer and fewer companies feel secure about the future. And if you feel less secure about the future, either because there's disruption or because of technology, and it's not just technology companies, you're starting to see food processing companies, manufacturing companies. This is a phenomenon that cuts across sectors where every company in every sector is looking at the future saying, I'm not sure what's going to happen over the next 10 years. And that's making them more reluctant to pay dividends. It's the stickiness of dividends that makes it so deadly for companies. Buybacks are just flexible dividends. That's the way to think about them. And if you look at 2020, remember how sticky dividends were in 2020? Buybacks, you started to see a lot more cancellations of buybacks than you saw dividends. There was a 35% drop off in buybacks in 2020. As companies said, you know what? We're going to hold the cash. In fact, I will give you an analogy on dividends and buybacks that you might find a little off-putting, but so be it. And I've been long trying to explain. I mean, this, you often run into people saying, well, why do companies, why have they stopped paying dividends? Because for old-time value investors, this is not a great phenomenon, right? Old-time value investing was built on buying stocks with big and predictable dividends. And there are fewer and fewer of those companies left. I tell them about a conversation I had, not really a conversation, but a talk with my daughter. She's turning 26 today. And this was when she was, around 7, maybe 7.5. I was driving her to a birthday party and she was in the back seat. She was tiny, so she had to be strapped into a car seat still at 7 because she didn't weigh enough. So in the back seat, she gives me directions on things to do, like turn the radio to Z100. And like a robot, I would do whatever she asked me to do. I said, like, can we try jazz? She said, no, I want to listen to Z100. So I turn on Z100, this song after song. I've not heard of any of the people, but between the songs, the DJs are involved in this conversation and they're talking about people I've never heard about. And then one of the DJs talks about hooking up. Show you how disconnected you get after 20 years of marriage. I wasn't sure what they were talking about. And then my 7-year-old from the backseat pipes up, explaining to me what hooking up is. Part of me is in shock that my 7-year-old, and the other part of me saying, this is a great way of explaining the difference between dividends and stock buybacks. You see that the dividends are like getting married, right? They're, in sickness and in health, in good times and in bad times, you have. Buybacks are like hooking up. And let's face it, companies don't want long-term relationships anymore. In fact, investors don't either. There's a lot of hooking up going on, and guess what? It's not going away, no matter how much you might wish it away. When we talk about dividend policy, we have to bring buybacks into the conversation. It is a way of returning cash. And we're going to talk about why some companies should always have more flexible dividend policies than others. But keep that in mind as you think about dividend policy. It's not just conventional dividends, it's also buybacks. Brian.
Can Apple use its huge treasure trove of cash in Ireland to buy stock back, or does it have to be repatriated?
It has, post-2017, you don't have to worry anymore. Pre-2017, because that cash was trapped, it could not have been used. One of the things that came out of the 2017 tax law is Apple was allowed to pay a one-time tax, which they did in 2018, and release that cash. So right now, none of Apple's cash is trapped. They can use it for buybacks, they can use it to pay dividends, you can use it to invest. So that's one of the things that came out of the 2017 tax law. And one reason in 2018, if you looked at corporate taxes, they jumped, was because many companies paid that one-time tax to get their cash back. Dan?
I guess if you go back to that chart 2 slides ago, something that popped out to me was in 09. I guess, like, why did it reverse? Do you think that's negative sentiment of the stock market?
Now wait, what did I say about dividends, about buybacks? They're flexible dividends, right? You have a terrible year,
Yeah.
and you have flexibility. What are you going to do? You're going to do the sensible thing, which is, hey, we shouldn't be buying back stock. We're in the middle of a crisis. We need every dollar. In fact, that's exactly what you want dividends to be doing too. In a bad year, I don't want you to pay the dividend you did last year. If you're a bank and you're undercapitalized, just stop paying dividends. So what you see in 2009 and 2020 is what you'd expect a sensible dividend policy to look like. And the fact that traditional dividends don't look like that is a sign of weakness to me, because it means companies are stuck paying dividends. They're afraid to cut dividends, even in the midst of catastrophe.
Okay, thank you.
Kyle?
How much of this trend of buybacks can be attributed to companies raising debt because interest rates have been so much lower than before?
What's the easy way to tell? Because I've heard that story. What's an easy way to debunk that story? If in fact these buybacks are being funded primarily with debt, what should happen to debt ratios over time? What should happen to debt to EBITDA over time? They should. I mean, you should see debt ratios go up, but you don't see that. Whether you look at debt to capital or debt to EBITDA, you don't see that. Are there some companies out there that borrow money to buy back stock? Of course. But you look collectively at companies, you don't see that phenomenon play out. So it's not debt driven. It's driven by forces that I think reflect the fact that dividend, I mean, I'll be quite honest, I've never understood the notion of fixed dividends. Remember how we described equity? It's a residual claim. You get whatever's left over. If it's truly residual claim, what should be true about dividends? They should go up in good times, down in bad times. They shouldn't be sticky, right? But you know why dividends evolved? And here there's a little bit of history that can help explain it. If you look at financial security markets, bond markets were born first before stock markets. Investors learned how to invest in bonds. And how does a bond work? You buy a bond, you get a coupon, right? That's how you make money. So when stocks were first introduced, to get investors to buy stocks, guess what they had to make stocks look like? They had to make stocks look like bonds. The dividend was the stand-in for the coupon. That was in the 1800s. And we're still stuck with this fixed dividend policy, which makes no sense. And it doesn't surprise me then that companies are moving away from it. Whether buybacks are the right place to move, we can debate. But I think the notion of sticky fixed dividends is inconsistent with equity being a residual claim. Shreya?
I was going to ask why dividends are more sticky than buybacks, but I think that explanation kind of answered quite a bit of
Well,
that.
yeah, it's part of it is just inertia, right? If you're told that something cannot be changed, we're going to talk about how investors react to dividend cuts. And you're going to see that this is a phenomenon that feeds on itself because people expect dividends to be fixed. It becomes very difficult for companies to cut dividends and get away with it. So the whole system is built on the presumption that dividends don't get cut very often. And when they get cut, you must be in serious trouble and you should be punished as a company. So I think the stickiness of dividends just reflects that long history of dividends being viewed like coupons, something that you think you're going to get year after year after year in good times and in bad times. Sarah?
Yeah, I guess just to that point, I'm having like a hard time wrapping my head around the incentive of a buyback, like from the point of view of an investor. Like,
okay,
as you mentioned, like,
let's step back. Let's make it very simple. You're a stockholder at a company. It's announced a buyback. What are the two things you can do? You can sell your shares back in the buyback or hold on to the shares.
right.
If you sell your shares in the buyback, you get cash. If you hold on to the shares, you get price appreciation. Why? Because there are fewer shares outstanding, you're getting the equity. So basically, I give you a choice as a shareholder in the company. Do you want to continue to be a shareholder in the company and get price appreciation? Or do you want to sell your shares back and get capital and basically cash out, get the cash today?
So is the incentive then the choice?
Yeah.
Okay.
Exactly. And that's why when people complain that buybacks happen at too high a price, I've heard people say, this is terrible. Companies are buying back. No, my company just bought back shares at too high a price. What's the first question you need to ask them? Teresa? Shareholder complains that the company keeps buying back shares at too high a price. Remember, Sarah, I said that was you had a choice.
I want to know like how many are not being sold and what like the difference in like value appreciation is.
And if you think it's too high a price, what's a logical thing to do? Just sell your shares back. Don't whine about it. So if you feel companies buy back shares at too high a price, there's an easy way out. Just sell your shares back at too high a price. You've taken advantage of the high price. Let somebody else bear the burden. But this notion that, that because you have buybacks, people are going to be hurt because share, it's a choice you face. Take advantage of the choice. And I don't see how you come out of this any worse off than if they paid dividends. Any other questions? So now let's look at traditional dividend policy. If you look at a company and say, does my company pay dividends? Does it have a high dividend? Does it pay out a lot in dividends? Does it pay out just about the right amount? You've got to scale dividends. You can't compare dollar dividends because bigger companies are going to have more dollar dividends. And there are two widely used measures of how much a company pays in dividends. The first is called the dividend payout ratio. What's a dividend payout ratio? Very simply put, it's a percentage of your earnings that you pay out in dividends. So if you have $100 in net income and you pay out $30 in dividends, you got a payout ratio of 30%. The second is what's called a dividend yield. In the dividend yield, I take the dividends I receive per share and divide it by the stock price. So if you pay a $2 dividend on a $100 stock, that's a 2% dividend yield. What is the dividend yield measure? It measures the percentage return you get from dividends. Remember when I did Disney's beta and I came up with an expected return of like 9%? And I said some of it will come from dividends, some from price appreciation. The dividend yield is the portion of my return that comes from dividends. The rest has to come from price appreciation. So when you get a chance, I'd like you to look at your company and look at what its dividend payout ratio is and its dividend yield is. And you're saying, what? After I get that number, how do I know whether it's high or low? Let me give you some perspective. At the start of 2021, I computed the dividend payout ratios of every publicly traded company in the world. And this is a graph of the dividend payout ratios of just the dividend paying companies. Notice how I phrase this, just the dividend paying companies. So for instance, if you look at US and global companies, you'll see that the median dividend payout ratio for a dividend paying company, the orange is the US, is about 30 to 40%. If you're a dividend paying company, about a 30 to 40%, is it 30? No, 20 to between 20 and 40%. Let's make it 30%. The median payout ratio for a dividend paying company in the US is about 30%. A couple of strange things in this graph. The first is look at the percentage of companies with a payout ratio greater than 100%. Are they crazy? Not necessarily. And here's why I said not necessarily. This was 2020, right? Many of these companies had a bad year in 2020. If you have dividends that are sticky, what do? You continue to pay those dividends, hoping that you come back. So it's not necessarily crazy. The hope might be misplaced, but part of the reason for those payout ratios that exceed 100% is you have companies hoping for a bounce back, oil companies hoping oil prices go back, hotel companies hoping that you come back to hotels. Now, they could be disappointed. The second group of companies which have payout ratios greater than 100% are companies in really bad businesses that are trying to get smaller and perhaps even go away. Do you see how this helps you? If you're in a bad business, what do? You return all the cash you have plus more. Essentially, you're making your company shrink to reflect the fact that you're in a bad business. You're not doing this because you're crazy, but because you're being realistic. So when you look at those companies above 100%, your first reaction is those companies are crazy, but that's not necessarily the case. So the median payout ratio for a dividend paying company in the US is about 30%. You want a nice trick question to be able to ask somebody? Ask them what the median payout ratio for a US company is. Just state it, because median payout ratio for a dividend paying company is 30%. You know what the median payout ratio for US companies? There are 7,400 US companies. The median payout ratios. Banish, do you want to guess?
Less than 30%?
It's 0%. Because here's why. Out of the 7,400 US companies, 2,200 paid dividends. And this is the graph for the 2,200 that paid dividends, but 5,200 don't pay dividends. The median is right in the middle, right? 3,700 firms. The median payout ratio for a US company is it doesn't pay dividends. So I'm preparing you for what may look like a surprise. When you look at your company, don't be surprised if your company doesn't pay dividends. That's the norm. In fact, be surprised if your company pays dividends, because that's more the exception than the rule. So when you look at the percent, when you look at payout ratios across the globe, clearly the US has a payout ratio of 43%, which is not that different from the global average. But there are parts of the world like Australia, New Zealand, but the payout ratio across companies, the median payout ratio was more than 100%. One thing to remember about Australia and Canada is they have a lot of natural resource companies. And you have a lot of natural resource companies. You look at 2020, 2020 happened to be a bad year. This is hope winning out over looking at the current year's numbers. They're hoping that these prices bounce back, and you see that show up in the payout ratio. And if your earnings are negative and you pay a dividend, your payout ratio becomes not meaningful. There are quite a few companies where that was the case, where you had companies that had paid dividends in spite of the fact that they were losing money. Any questions on the dividend payout ratio? It's been used for a long time as a measure of dividends, and you can see it play out. Let's talk about dividend yields. If you look at dividend yields, remember this is the dividend as a percent of the price. The median dividend yield for a US company last year was about 1 to 1.5%. Among dividend paying companies, 1 to 1.5%. You know what that number looked like 40 years ago? Among dividend paying companies, the median yield was about 4 to 4.5%. You see, this is terrible. I wish I'd been born in 1981. Be careful what you wish for. Because you know what the T-bond rate was then? It was 8.5%. You see the connection between the two. As risk-free rates have come down, dividend yields will also come down because prices go up. The dividend yield now for a dividend paying company is 1.5%, maybe 2% if you're lucky. You're saying, what about those companies with 7, 8, 9% dividend yields? Be very careful with those companies. Because if you see a 6, 7, 8% dividend yield in this market, you know what it tells me? That these companies are on the verge of catastrophe. Usually when dividend yields rise to that amount, it's not because dividends went up, but because the price has dropped. Why is the price drop? Because investors see things in this company that they don't like. The company's continuing to pay dividends as if nothing has changed. But I know there are people who invest based on dividend yields, and it's a very dangerous investment strategy because your portfolio will contain basket case companies you wouldn't want to invest in the first place. So payout ratios look at dividends as a percentage of earnings. Dividend yields look at dividends as a percentage of the price. And on both measures, don't be surprised if your company has a 0 yield and a 0 payout ratio. Doesn't mean it doesn't return cash. It could return cash in the form of buybacks. But many companies don't pay dividends anymore. Any questions? So let's think about a very simple framework for understanding dividend policy that goes back to something we've used before. We talked about the corporate life cycle, right? Where you have young companies, teenage companies, peak of your life companies, middle-aged companies, old companies, dying companies. Think of how dividend policy will evolve as you go through this life cycle. And think of it in terms of the cash flows you have available as a company. If you're a young startup, how much should you pay in dividends? Are you kidding me? What are you going to pay in dividends? You're money losing, you have all this cash you need to grow. Of course, you shouldn't be paying dividends. In fact, young companies in general, even if they're making money, shouldn't pay dividends, because even though they might be making money, they need to reinvest all that money and more for future growth. But young companies at some point in time will start to get middle-aged. How do you know you're middle-aged? You'll start to see cash come in and not enough projects to take. Your cash balance will start building up. And initially, you know what you're going to try to do? You're going to fight age. You're trying to say, I'm not middle-aged, I'm still a young growth company. But when your cash balance hits some amount, you'll have to get past the denial and say, you know what, guys? We're no longer the young company we used to be. We need to start returning cash to shareholders. And it doesn't come easy. You know what ultimately forced Apple to start paying dividends and doing buybacks? Was in 2011, Carl Icahn took a 1% stake in the company, such a big company, that's about all he could do. And he started making noise about how the company needed to borrow money and return cash in the form of dividends and buybacks. And Apple's initial reaction is, we're a growth company. We don't want to do this. And then 2 years later, the cash balance are almost quadrupled. And they found that they had fewer and fewer bases for not returning cash. And eventually, not only they start returning the cash in the form of dividends, they started buying back stock. In fact, you know how much cash Apple has returned to its shareholders just in the last 5 years? More than $350 billion. That's the amazing thing about Apple, is it's a company that's worth $2 trillion while returning $350 billion in the form of buybacks and dividends. So you tell me where you are in the life cycle. I can make a guess about how much cash you should be returning, even if I cannot guess whether it's in the form of dividends and buybacks. Young companies should return no cash. Middle-aged companies should return even more cash. And if you're an aging company, you might return more than 100% of your earnings as cash, because you're declining. You're, in a sense, liquidating yourself as you go along. So think about where your company in your that you pick for your project is in the life cycle, and it'll at least start to give you some sense of why it adopts the dividend policy that it does. One of the things I do on a regular basis is I break companies down based on their expected growth rates, from highest growth to lowest growth companies. So basically, you see growth rates 0 to 3 ranging to more than 25%. And I graph out the dividend payout ratios and dividend yields at these companies. No surprise here. High growth companies pay out a much lower dividend as a percentage of earnings or as a percent of stock price, either with payout. No, low growth companies tend to return more. So it's stating the obvious, but it's good that the numbers do back us up. Low growth companies tend to return more cash. High growth companies tend to return less cash. And really high growth companies will return no cash at all. So I'm going to take my 5 companies and list out what they pay out in dividend, what they have is dividend payout ratios and dividend yields. And you can see some strange things happening with the numbers, but we'll talk about why they might be. So this is in 2013. There's Disney, Vale, Tata Motors, Baidu, and Deutsche. If you take Disney, their dividend yield was 1%, their payout ratio was 22% in 2013. If you look at the 5 years preceding, it's pretty close. So the dividends, with Disney at least, it looks like they return about 20% of their earnings in dividends, and that dividend translates into about a 1% dividend yield. When you look at Vale, the dividend yield in 2013 was almost 7%, 6.56%. They were returning more than their earnings as dividends, 113%. But look at the previous 5 years, those numbers were much lower. Saying what's going on? Remember, Vale is an iron ore mining company. We talked about how natural resource companies, when the price of the commodity drops, will often continue to pay the dividends they used to, hoping that the price bounces back. Because the danger here is if it never bounces back, you're going to be stuck with the dividend policy that you cannot really change. But that's one of the things you will notice with natural resource companies. With Tata Motors, the dividend yield and payout, like Disney, is pretty close to what it was in the previous 5 years. Baidu is my easy one. 0, 0, 0, 0, 0, nothing to analyze there. The return, no cash, which makes sense. They're a young company, they're a growth company. And finally, there's Deutsche Bank. Their dividend yield was 1.96%. Their dividend payout ratio was 362%. That's insane, right? Well, part of the reason is their stock price collapsed in 2013. Why did it collapse? They had all kinds of scandals going on, but their dividends held on. And in fact, they continued to pay dividends for almost 3 years before the stock price completely imploded. And they finally said, you know what? We're cutting dividends. It takes a long time. Remember, we described dividends as following earnings. It took them almost 5 years of bad earnings before they finally threw in the towel saying, we can't continue to pay these dividends. Banks are among, if dividend policy is insane in many companies, banks are among the worst culprits. Now, explaining bank dividend policy, you look at them and say, why are you guys still paying dividends? Your capital ratios are terrible. You need to raise fresh capital, but they continue to pay these dividends. So with that setup, I'm going to do some qualitative analysis of the trade-off. Remember how with debt and equity, we looked at the pluses and minuses of debt? No. Before I do that, Priyanshu, question?
Yeah, regarding the bank paying out dividends. So as I understand, that banks are valued based on their dividend discount model. So is one of the
But you're
reasons.
now in a circular reasoning, right? How do you know what banks are valued on? And if you start with that presumption that if you're a disastrous bank and you pay dividends, do you think I'm going to give you a high stock price? I mean, I have to be insane as an investor to pay you high. It suggests that you have got these really short-sighted investors in banks who just look at the dividend. And I think it's a very dangerous point of view to bring in. I still remember in 2009 talking to banks that were continuing to pay a dividend. And these were some of the biggest money center banks in the world. They were all capital damaged. We all knew they were in trouble, but they continued to pay dividends. The CFO of a very large bank. And I said, why do you guys keep paying dividends? You know what he told me? He said, we don't want to send the wrong signal. I said, are you guys crazy? What kind of signal are you sending me? I can see that you're in trouble. Paying dividends just tells me that you're in denial, that you can't even see how much trouble you're in. So I know the defense banks offer is investors and our companies care about dividends, therefore we can't cut dividends. So basically they continue to pay dividends right till the edge where they go over the edge. So I agree with you, it'll take an adjustment phase. I'm not suggesting it's going to be easy, but paying dividends when you know the bottom is falling out of your business is extremely dysfunctional. Yeah. Any other questions about? So we're going to go through 3 schools of thought on dividends. They cover the spectrum. First school of thought says, if there are no tax disadvantages to investors, they don't care whether they receive dividends or capital gains. And companies can raise as much equity as they want to cover projects at a reasonable cost. It does not matter how much companies pay in dividends. They can pay a high dividend. Your value per share that I attach to you as an investor will be the same no matter how much you pay in dividends. Does that sound remotely familiar? Now, remember a few sessions ago when we were talking about capital structure, we talked about how it doesn't matter how much you borrow. Miller Modigliani 1. This is Miller Modigliani 2. In a world where investors don't care whether they receive dividends or capital gains because they're taxed the same on both, and where companies can raise equity capital, it doesn't matter how much you pay in dividends. If we lived in a Miller Modigliani world, we could have stopped this class after week 8. Because after you run investment analysis, it doesn't matter how much you borrow, it doesn't matter how much you pay in dividends. But I'm going to talk about the basis for the Miller Modigliani argument that dividends shouldn't drive the value. In fact, it's the exact opposite of what Priyanshu is saying, where the value of the firm is the value of the firm. You can't alter it by playing games with the dividends. There's a second school of thought. And this was a school that actually had a very strong following in the US in the 20th century. And was based on the premise that dividends create a tax disadvantage to investors. And I'll tell you what the basis for that was. For much of the 20th century in the US, dividends were taxed as ordinary income. 30, 40, 50%, whatever your ordinary tax rate was. Capital gains were taxed as capital gains, often 15, 20, maybe even 10%. So as an investor, if you receive dividends, you had to pay a 40% tax rate. If you receive capital gains, you got only a 10% tax rate. So the question was, why would a company ever pay dividends when it can buy back stock and allow people to claim the capital gains and pay much less in tax? So according to this school, any company that pays dividends should be worth less than a company that doesn't pay dividends. Wait, there's a third school of thought that kind of covers the spectrum. So the first school, Miller Modigliani, says dividends don't matter. The second school says dividends are bad, don't pay them. There's a third school of thought that says that there are investors out there who like dividends. We'll talk about what kinds of investors might like dividends. And if your shareholders happen to draw from that group, paying more in dividends will make your company more valuable because these investors like dividends enough that they'll bid up your price if you pay a higher dividends. This is extraordinarily convenient if you're a CFO, right? Because no matter what you do, you got an entire school of thought backing you up. If you cut your dividends, you point to the dividends are bad school. If you increase dividends, you point to the dividends are good school. If you have no idea what you're doing with dividends, you say, oh, you're in the Miller Modigliani school. And I'm going to say something weird. There is some truth to all three schools of thought. And I'm going to draw on each one, at least the portion that I think makes sense. And at the end of this, I'm going to argue that none of these schools actually has a monopoly on the truth. And here's how I think about dividend policy. If you're a company that is throwing off a lot of excess cash from your projects, and you don't have very many investment opportunities, why? Because your business has become a pretty bad one, then you should return more cash to your shareholders. Now, we can debate whether that should be dividends or buybacks, but basically, if you have a lot of cash coming in, you don't have much use for it, you got to find a way to give that cash back to shareholders. On the other end extreme, you don't have very much cash coming in as a company, and you have lots of investment opportunities. I don't want you returning that cash because I'd rather you take the cash and take those investments. Remember, I get the positive net present value, I get the increase in value from it. Now, later on, we're going to come back and talk about how do we measure cash coming in? How do we measure the quality of investment opportunities? But that's where we're going to end up. But before we do that, let's look at the three schools of thought and the basis for why they arrive at the conclusions that they do. So you guys be shareholders of the company, and I'm going to be the CFO of the company. I'm trying to decide how much to pay in dividends. Let's say that based on the risk in the stock, you expect to make a 9% return on the stock. If I pay no dividends, you get 0 in dividends, but the cash gets held in the company, your price appreciation is going to be 9%. So the cash doesn't damage you, it stays in the company. If I pay a lot of dividends, you might get a dividend yield of 3%. You're saying this is good. But because the cash leaves the company, the price appreciation portion is going to drop from 9 to 6%. Overall, you make 9%. So no matter what I do in terms of dividends, you earn 9%. The only difference is how much of it comes from dividends and how much comes from price appreciation. But remember, in the Miller Modigliani world, they both get taxed the same way. If they both get taxed the same way, you as a shareholder say, I don't care. Pay whatever you want in dividends. It just breaks down the 9% into different compositions. Now let me turn my attention to my side as a company. Let's say I'm paying out more in dividends than I can afford to. It's true, you don't care, but I have a problem, right? When I pay out more in dividends, I have a cash shortfall I've got to make up. But in the Miller Modigliani world, I'm able to go out and raise new shares at a fair price. And if I can do that, I would continue to take the same projects I would have if I hadn't paid the dividends, but with new shares issued. So as a company, I'm not changing anything that I do. I still take exactly the same projects. I still get the same net present value. So whether I pay dividends or not, my value as a company is driven by the value of those projects. So I'm unaffected as well. So in the Miller Modigliani world, neither the company nor the shareholders is affected by how much is paid in dividends. All it alters is how much of the returns you make from dividends and how much from price appreciation. There are some companies which get pretty close to this word. So if your investors are primarily pension funds, Pension funds don't pay taxes on dividends or capital gains. So if your investors are, let's say, 90% pension funds, and you're a company with very good access to capital markets, you could argue, a company like this, who cares how much they pay in dividends? You pay too much, you pay too little, your value is going to be relatively unaffected. But let's move to the second school of thought, that dividends are bad. As I said, this school of thought was born in the 20th century in the US, and you can see why. If you look at this graph, the purple line that you see on top is my tax rate on dividends. The green line at the bottom is my capital gains tax rate. For much of the last century, especially from the 1920s all the way through 2002, dividends were taxed at a much higher tax rate than capital gains. In fact, in the peak years, if you look at 1956, 57, the tax rate on dividends was as high as 90%. This is the highest marginal tax rate that individuals face then, and 90% tax rate on dividends. Dividends and capital gains was 25%. So for much of the last century, dividends were taxed at a much higher tax rate than capital gains. There's a brief period in 1986 where Congress said, we're going to make tax laws simpler. They brought the tax rates on dividends and capital gains together, but they very quickly changed their minds and the two started to deviate again. Until you get to 2002 and the Tax Reform Act of that year brought the tax. So since 2002 in the US, we've had the same tax rate on dividends and capital gains, but prior to that, dividends used to be taxed at a much higher rate. So the basis for dividends are bad is a tax argument. Investors receiving dividends, at least for much of the last century, paid much higher taxes than investors receiving an equivalent amount in capital gains. Now that disadvantage should have gone away, right? No, not quite. Because there's one remaining disadvantage with dividends that you don't have with capital gains. And that disadvantage with dividends is you don't get to pick when you pay taxes. Why? Because the minute dividends are paid, you don't have a choice. It shows up as income, you have to pay taxes. Capital gains, though, you determine when you pay taxes based on when you sell the shares. There's a timing option with capital gains you don't have with dividends. So even though the tax rates on dividends and capital gains are now the same, there's still a residual tax advantage for capital gains as opposed to dividends, but it's much less than it was 30 or 40 or 50 years ago. In fact, in the last century, especially go back to the 1980s or 90s, the tax rate on dividends and capital gains was so different that one of the things that you worried about when you looked at a company is, who are the investors in my company? Are they the investors who care about dividends being taxed at a higher rate? And should I be factoring that into my investment decision? And there's actually an indirect way in which you can get a sense of what investors in your company think about dividends as opposed to capital gains. And here's where it happens. Now, when you look at how companies set dividends, there are three big dates around dividend policy. The first is what's called the announcement date. That's when the board of directors of the company gets together and announces what the dividend will be for the next quarter. So what are the three things they can announce? Dividends are going to be the same as last year, which is not a big deal. They can announce an increase in dividends, which is often viewed as good news, or a cut in dividends, which is often viewed as bad news. That's the announcement day. That's the day where you see the stock price react. So you'd see a Wall Street Journal announcement that, Marriott announces cut in dividend, stock price drops 18%. That's the announcement day. About 4 weeks later, there's a record date. This is the date by which you got to buy the shares for it to actually register you. So you get a period of time after the announcement to make that judgment, but there's a date called the ex-dividend day by which you got to buy the shares. So think of the ex-dividend day as the date on which ownership of the dividend passes hands. Anybody who owns the shares at the end of the ex-dividend day will end up receiving the dividends. But if you sold it before the ex-dividend day, you don't. So the ex-dividend day is the date in which ownership of the dividends passes hands. And then there's the actual payment day, which is the day the dividend arrives in your bank account, or you get a check in the mail for the dividends. Announcement day, ex-dividend day, payment day. I'm going to focus on the ex-dividend day because looking at what the stock price does on the ex-dividend day might actually give you a sense of what investors in your company think about dividends as opposed to capital gains. And let me explain. Let's assume that we're all shareholders in a company. Tomorrow is going to be the ex-dividend day. And by now, remember, we all know what the dividend is going to be. It's going to be $2 per share. The stock is right now trading at $50 per share. And each of us faces a choice. We can hold on through the end of tomorrow and collect the dividends, or we can sell today and lose the dividends. Now, what's your first reaction? Why would I ever sell today, right? If I can hold on one more day and get the dividend, why would I ever sell today? You know what has to be true for this market to be in steady state? If the price stayed at 50 and you could collect the dividend, nobody would sell shares before ex-dividend days. So guess what has to happen on the ex-dividend day for you to be indifferent between selling before and selling after? Stock price is 50, there's a dividend tomorrow. At the end of tomorrow, the stock price has to be lower than today, because otherwise everybody's just going to hold on and collect the shares. So the trade-off you have to have is, do you want to collect the shares today and get the $50 and not deal with the dividend, or get the dividend and accept a lower stock price? So I'm going to give the price at the start of the ex-dividend day a notation. I'm going to call it PB. I'm not being particularly inventive here. It's the price before the dividend day, and the price after is the PA. So here are your choices. If you sell before, you get PB, and that's it, you're done. If you sell after, you get PA, but you also get the dividend. Let's assume the tax rate on dividends is TO, and the tax rate on capital gains is TCG. Now, remember, the way capital gains works is you're not taxing the entire amount you get from selling the stock. You get taxed on the capital gains, the difference between what you sold the stock for and what you originally bought. So let's assume that we all bought shares at a price 5 years ago or 10 years ago for P. So here's what your cash flows would be if you sold before. If you sold before, you're going to get PB. You're going to have to pay capital gains tax on the difference between that price and what you originally paid times the capital gains tax rate. You're done. You don't get the dividend because you sold before. If you sold after, you get PA. You pay capital gains on that price, but you also get the dividends on which you get paid, or on which you have to pay the ordinary tax rate. I know it's getting incredibly abstract, but hang in there. There's an end game in play. For you to be indifferent in selling before and selling after, what has to be true? These two cash flows have to be the same. Otherwise, you'd be doing one or the other. And if I set the two equal and solve, here's what I get. The price change on the ex-dividend day as a percent of the dividend has to be a function of your ordinary tax rate and your capital gains tax rate. In other words, if you paid the same tax rate on dividends and capital gains, the price drop will be roughly equal to the dividend. Remember the $2 dividend? Your price would drop by exactly $2. But if you're taxed at a higher rate on dividends and capital gains, the price drop on the ex-dividend day will be smaller than the amount you receive in dividends. In other words, you'll accept a smaller price drop because you pay a higher tax on dividends and on capital gains. I know this sounds incredibly abstract, so who really cares? We can observe what happens on ex-dividend days to stocks. In fact, if you have any share that pays dividends on the ex-dividend, there'll be a little X next to the stock. If on average, dividends and capital gains at your company are taxed equally, or in your country are taxed equally, you should expect to see dividends, the price drop be roughly equal to the dividend. If dividends are taxed at a higher rate than capital gains, as it was in the US for much of the last century, the price drop should be smaller than the dividend. And if dividends are actually taxed at a lower rate than capital gains, there are some countries where dividends are not taxed, but capital gains are, then you should see the price drop be higher than the dividend. So here's what we do. We look on ex-dividend day. We look to see how much the price changes relative to the dividend. And from that, we try to make a judgment on, are the stockholders in this company investors who are taxed at a higher rate on dividends and capital gains? We're making a judgment call based on that one day. But that's a day where you can observe investors with different tax rates play out on the same stock. So if the new tax law passes and capital gains get taxed at 43.6%, and the bulk of the investors in your stock are very wealthy people, you know what you should expect to see on ex-dividend days? If your dividends continue to be taxed at 20%, if capital gains get taxed at 43.6%, you should expect to see the price drop in ex-dividend days be greater than the amount of the dividend, because this will be a scenario where capital gains get taxed at a higher tax rate than dividends. And this is something that's been studied in finance. Studies over the last 50 years have looked at the price drop in ex-dividend days relative to the dividend. One of the earliest ones was done by Marty Gruber and Hamilton, who taught at Stern. And they, at the time that they did this, the ordinary tax rate, the tax rate on dividends was 70%, the tax rate on capital gains was 28%. And what they found when they looked across all stocks was the price drop was only 78% of the dividend, which is to be expected, right? Dividends are taxed at a higher rate. So a $1 dividend created a 78-cent drop in the stock price. You go to 81 through 85, where the difference had become smaller, the price change had become 85% of the dividend. And then you get to the 1990s, where you actually, the second half of the 1980s, where the tax rates were the same, the price change as a percent of dividend was 90%. It didn't get to 100%. That's a timing option still there. Even though the tax rates are the same, you're not seeing the price change become equal to the dividend. But as the difference narrows, the price change becomes closer and closer to what gets paid out as a dividend. Now, obviously, not everybody in the market pays the same tax rates. As I said, pension funds pay no taxes. So let's assume that this is true, that the dividend, you know what the dividend is by the ex-dividend day. You know, on average, the stock price is only 90% of the dividend. And you're a tax-exempt investor. Is there a way you can take advantage of the fact that the price drop is not equal to the dividend and the fact that you don't pay taxes to make money on this divergence? House, help me out. So you're tax exempt. Tomorrow is going to be an ex-dividend day. It's going to be a $3 dividend on a stock. History suggests that the price will drop only 90% of the dividend. What could you do to kind of seal in a profit here?
I want to say B, but I am just guessing.
Well, you could, what if you bought the shares? Let's go along. Let's say you go out and buy the share today, right? You hold it through tomorrow. You get the dividend. The price drops only 90% of the dividend. You get to keep the difference, right? Because remember, the dividend is $3 and the stock price drops only $2.70, you get to keep a 30-cent difference. If this price drop is less than the dividend, you're going to come in and buy, you have to do it in huge quantities, because 30 cents is enough. Maybe buy 1 million shares before the ex-dividend day, hold it for the day, collect the dividend, sell at the end of the day. If you get a chance, look at trading volume on ex-dividend days, especially on big dividend paying companies, utilities, banks. You'll notice a big jump in trading volume. You know what's happening? A lot of tax-exempt investors do this. It's called dividend arbitrage, where they come in and they take advantage of the fact that the dividend drop is less than the amount of the dividend, and they're trying to capture the difference. But be careful. This isn't going to happen in every dividend-paying stock. It's on average across dividend-paying stocks. I remember a story of an Oregon pension fund. It's a small pension fund. It was a state or a county pension fund. But the treasurer of the fund read a story about dividend arbitrage and decided that he was going to take half of the pension fund's money and buy one big dividend paying stock before the ex-dividend day and collect the difference, because he said, this is an easy way to kind of pump up my returns. The day he picked was October 19th of 1987. Those of you who don't remember what happened that day, the S&P 500 dropped by 22% that day. The day the market drops 22%, forget about what the averages say. His stock dropped by about 19%. He collected the dividend, but gave up a 19% price drop. Of course, he got fired the next week. But dividend arbitrage requires that you do it in a lot of dividend paying stocks. And if you don't believe it's still happening, just take a look at trading volume around dividend paying stocks. And if the tax law on capital gains changes, you're going to see this phenomenon play out, because you're a wealthy individual and you want to avoid capital gains. It's going to be a lot of trading. Anytime tax rates for different investors gets different, you're going to get this kind of trading happening simply because of tax differences. Any questions on the dividends are bad and how to use the ex-dividend date to capture that divergence? So if you're tax exempt, take advantage of the fact that you're not being taxed, and you can then take advantage of the fact that the rest of the market cares about taxes, but you do not.
Don't you feel a lot of investors are using their dividends to buy back fractional shares now? So that's kind of like a weird phenomenon now.
The reinvestment of dividends, some of them are. It's actually a much smaller percentage than most people realize, because remember, when you use dividend, many companies have dividend reinvestment plans. You know that, right? Basically, you can say, don't send me the cash for the dividend, just reinvest it back in the company. Remember, when you do that, you still are taxed on the dividends. So even though you aren't getting your cash in the mail, the IRS will still act as if you have to pay taxes. So make sure you have enough cash to pay the taxes. But the problem with fractional shares is, it's a pain in the neck. Right? When you look at your portfolio, you own 103.5 shares at 100. So it's a pain in the neck to kind of track and continue. But it's a choice that you have in companies. You can reinvest the money in the company if you want to keep it in the company, or you can take it out. But either way, you're going to get taxed. There's no way around that. Any other questions on dividends? So, and around the world, the taxes on dividends and capital gains are all over the place. I know in India for a long time, capital gains were not taxed. Dividends were. And so in different parts of the world, laws keep changing. So check to see what the tax laws are, because they can often explain strange looking investment behavior. Australia and the UK have some of the highest dividend paying companies in the world. And one reason for that, in the Australia and the UK, when you receive dividends from a company, you're allowed to claim a credit for taxes that the company might have paid on the income from which they paid the dividends. So as an example, you had $100 in income, you pay 30% as taxes as a company, and then you pay out dividends. Investors who receive dividends are then allowed to claim the corporate taxes paid as a credit, which means that you actually pay low or no taxes on dividends as an investor in the UK and Australia. So guess what that does? It encourages UK and Australian companies to pay far more in dividends because of the way the tax law is structured there. So as an example of dividend capture, here's how it would work. So let's assume you have a stock trading at $50, close of trading May 3rd. May 4th, the stock is going to go ex-dividend, pay $1 in dividends. And let's say based on past history, and that's all you have, the price drop is 90% of the dividend. You go in and you buy 1 million shares of XYZ stock, cum dividend. That means you basically bought it before the ex-dividend day. You pay $50 per share. You wait till the stock goes ex-dividend. You sell the stock if the expected drop is right at $49.10. You collect the dividend. You make $100,000 profit on a one-day transaction. And if you can do this on thousands of shares that go pay dividends, you can see it's a way in which you can add to your returns as an investor. But the key is this 90% would start rising. More and more people play this game. 90% is going to become 92, 93, 94, 95. And the very biggest dividend paying stocks, it can get as high as 97 or 98%, because the investors playing games have now become almost tax exempt, almost entirely tax exempt investors. So let's talk about reasons for paying dividends. And let's start with the bad reasons first before we look at the good ones. There are two bad reasons for paying dividends. One is called what you call the bird in the hand fallacy, which is that investors will pay more for a company if it pays dividends because they see the dividends as cash in their hand rather than price appreciation as something that they will get in the future. So CFOs of companies will tell you, look, if you pay dividends, investors will pay us a higher price because dividends feel more certain than capital gains. There's a ring of truth to that, right? Dividends, you collect the check, capital gains, who knows? That is if you compare dividends now to capital gains way out in the future. But remember what happens on the ex-dividend day. Your stock price drops by roughly the amount of the dividend, right? So if I gave you a choice between dividends today and capital gains today, think of selling the stock today. There is no certainty. So you get exactly the same cash if you sold the shares today. So don't pay dividends expecting investors to pay a premium for your stock, especially in this market. You're not going to get that premium. Investors will not pay a premium for shares just because it pays a dividend. Here's the second one. We just had a good year. Why not just pay more dividends? This can happen, right? A company has a really good year. 2020 might have been a really good year for your company because you're a grocery store. Why shouldn't you increase dividends? Because if you increase dividends, you're kind of stuck paying those dividends for the foreseeable future. And if you have great plans for the future in which you want to grow and reinvest money, why would you want to take that cash and pay it out as dividends now and then go out and raise capital next year, 2 years, or 5 years from now? If you as a company have plans to grow in the future and you need the money, don't pay the dividends out now just because this year looks like a surplus year. And you say, well, how much is it going to cost me to raise capital? Plenty. This is an old graph that looks at the cost of raising capital for public companies. First, bigger companies, the cost is smaller than smaller companies. The larger the issuance, the lower the percentage cost. And raising money from new equity, the purple, is much more expensive than raising money from new debt. So if your fallback is I'm going to pay the dividends now and issue shares, the only people who are happy about this decision are your investment bankers because they're going to be collecting the fees when you make those issuances. In 2019, let's skip 2020, it's a strange year. In 2019, out of the 7,400 US companies, at least 500 paid dividends and issued shares in the same year. And that strikes me as crazy. To pay dividends out of one window and issue shares of the other, it's not even that you're borrowing money to pay the dividends, you're actually issuing shares to pay dividends. So if you need the cash to take projects, don't initiate or increase dividends in the first place, because it's only going to make things worse. I'm at least going to start on 3 good reasons for paying dividends, but I'll come back and flesh these out in the next session. Remember I said there are some investors out there who like dividends. What kind of investors do you think like dividends? Let's lay the foundation. Dean, if I'm a company and I'm looking at investors, look across investors, what types of investors do you think like to receive their returns and dividends? Let me give you some guidance in terms of age.
Retirement.
Older investors like dividends. Why? Because they need the cash. They want to sell the shares. So older investors prefer dividends more than younger investors. In terms of income, rich versus poor. Poorer, the really poor don't have shares in the first place. So rich versus middle class. Middle class and poorer investors like dividends more than richer investors because they actually need the dividends in terms of cash to meet their needs. So older investors, poorer investors. Among institutions, some kind of institutions like insurance companies like dividends. Why? Because they have cash flow claims they have to meet. So they need dividends from the cash flows. There are investors out there who like dividends. And guess what? If you pay a lot of dividends, guess who buys your shares? This is selection bias. The people who like dividends tend to buy your shares. And over time, you're going to acquire a clientele that likes your dividend policy. There are investors out there who hate dividends. And if you're in a company that doesn't pay dividends, guess who you attract? Investors who don't like dividends. You think this is great, we'll self-select the investors we like. You know when you get into trouble? Is when you're a company that pays a lot in dividends, you acquire a clientele that likes dividends, and then suddenly the game changes under you. The old phone companies, the last century, used to be among the biggest dividend payers in the US. Starting with Ma Bell, right? There used to be only one big phone company, AT&T, then it split up into like 9 regional phone companies, each used to pay big dividends. Why could they pay big dividends? Because it had investors who liked dividends, and they were also in regulated, safe monopoly businesses. And then technology undercut them. All of a sudden, telecom companies woke up to the fact that they were no longer in safe businesses where they could predict earnings, but they were still paying dividends. So we're going to talk in the next session about what to do when the world shifts under you and you have to shift dividend policy, because then your clientele that you've already accumulated are not going to like what you're planning to do. So we're going to talk about dividend clienteles. We're also going to talk about a story you often hear about dividends, which is you can use dividends to signal to the market what your future looks like. In other words, if you're a company with great projects in the future, You might actually increase dividends to tell the world, look how good we are, pay attention to us. And you're going to see the signaling story can be used to cut both ways. Increasing dividends can be a good signal, or increasing dividends can actually be a bad signal in some companies. And finally, dividends may be a way in which you can transfer wealth from bondholders to shareholders. I'm going to leave it at that, and I want you to think about it. But if you're shareholders in a company, increasing dividends might be a way in which you make bondholders worse off and shareholders better off. So next session when we start, we'll look at these 3 good reasons for paying dividends, and then we're going to dive into ways in which you can assess whether your company can afford to pay more or less in dividends. I'll see you on Wednesday. Take care.
Thank you.
Thank you.